This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So the fun continues for us value people in 2022 because the value sectors are all hot while growth is not. This is a new fundamentals for us, a new way of looking at things, because even when value had these mini rallies over the last couple of years, growth still stayed pretty hot as well. So this is the first time that everybody's complaining or, lamenting or in pain about their stocks, but many of us are not, at least about our value stocks. We may own some growth stocks too. As I've mentioned in prior podcasts, it's okay to own both. So some of those may be getting hit, but our value stocks are not. So we're really not worrying about the 50% sell-offs right now, even if some areas that we're in have been weak. And weak means about, maybe 10% down, not the 40 or 50% down for the most part. But I've also been thinking while all of this selling is going on in the growth stocks about some of the superstar investors that have been around over the last couple decades. Of course, right now, that means Kathy Wood at ARK Invest. We're all watching those ARK ETFs right now, right? Because that is an area where they've seen the huge sell-off. And ARK K was down 50% at one point. It's bounced off those lows, but it's been pretty brutal if you're investors over there. And I was also thinking about the old-time favorites like Peter Lynch at Fidelity's Magellan. He retired basically around 30 years ago. So not many of you may have ever heard of him. He's still alive. He's still out there, but he really hasn't worked in the industry in 30 years. So only some of us old-timers really know who Peter Lynch is nowadays. And he's kept real quiet. Doesn't go on TV and give interviews. He's no longer writing books, but some of his books from the 1980s were bestsellers at that time. I do still recommend people check out his investing books, even though some of the stocks in there, it'll seem kind of old to you now because there's not like updated versions of it. Kind of like the Intelligent Investor seems old with some of its examples. But a lot of the names are still around and you can still relate and get the good concepts out of there. So he had a skill of buying companies that had strong brands and he wrote it to big profits. He liked a lot of retailers, restaurants, companies that were kind of regional to begin with, that had big growth ahead of them because, as he always used to say, it takes a long time to open up stores from coast to coast just in the United States. And then if you add on, it takes a long time to expand internationally, you can see the longer growth trajectory for a lot of those kind of consumer-focused brands. And now we even have online sales, but it still takes a long time to get online really ramped up and competing against something like an Amazon or just getting it to a place where the consumer doesn't even really think about ordering online because it's so easy. That's taken a lot of retailers, I would say at least even 10 years to get to that place. So newer retailers are also going to have a growing period on that aspect of it too. But he liked buying those kinds of companies that, maybe people were not really familiar with because they lived in another part of the country and that maybe had some value kind of component to it, but still did have the growth. He talked about in one of the books about buying Home Depot for only like $1 a share after it went public because he drove down, I think it was in Atlanta where they were, and he went to one of the stores and he was like, this is fantastic, and immediately decided to buy the stock because he loved the store so much. And it has taken Home Depot a long time, again, to expand across the United States. And even now, again, internationally, it's in some international markets, but not as many as you might think. So that's the kind of company he liked to buy. And he did it also by using one of the common classic value fundamentals that we use a lot here on this podcast. So he liked to use the PEG ratio. to find those companies that had the growth, but that were also on sale. The PEG, remember, was basically kind of invented by the father of value investing, our favorite guy, Benjamin Graham, the mentor of Warren Buffett, remember, the author of The Intelligent Investor. And he is considered the father of value investing. And Ben Graham also liked to use the PEG ratio because basically, frankly, it works. It works to find cheap stocks with that growth component. It's kind of a rare combination, but those stocks usually do outperform. Now, if you're screening for the PEG, I know you're thinking like, well, what do I use? What is the PEG? Like, why? Well, I could just go on a screen and there it is, but what do I look for? And for value investors, we want to look for one under one. The PEG has to be under one. And that means the PEG, remember, is the PE over the growth rate. And under one means you're getting it undervalued with the growth. So kind of like how we always look for the price to sales under one, the PEG under one is a similar like basic metric for value investors. So I decided to run a basic screen. This is really basic, just using the PEG under one, but I added the Zacks rank, of course, of ones or twos because I want to get the buys or the strong buys. The Zacks rank will give me a little bit extra firepower, but I'm not sure what it's doing ahead of earnings season because the Zacks rank will change dramatically during earnings season. When those earnings reports come out, the analysts go, oh, they missed, or oh, they beat and raised, and they gave great guidance for 2022. We have to raise our estimates now. And then they'll all raise on whatever company is doing that, and then the Zacks rank will improve, will go up to probably a 1 or a 2 for that particular company. So all that will happen during earnings season, which is just only beginning here in the week of January 10th here in 2022. So this rank, these are companies that already have the ones or twos going into earnings season. So something good must be going there if they're holding on to these high ranks and they haven't even reported yet. So I do like that aspect of it, but it also is going to be a little tricky, I think, in like what it gives us. But I ran it with just this basic screen and I got 98 companies. Okay, that was just way too many for me. So I thought, well, why not just go for the top of the heap, the best, the Zacks number one rank, strong buys only. That's a very narrow group, usually around 210 to 220 stocks, but it is the ones where the rank, the estimates are being changed recently and strongly, and the analysts are all in agreement. So when I screened only for the ones, I still got 35 companies. That was more than I thought with the PEG under one. But that just tells you kind of where we are with value stocks to start 2022. The value stock category is strong because those earnings are rising for a lot of the cheap, neglected companies in sectors that weren't the glamour growth sectors. We all know what they are. Energy, which is still hated. Then, of course, home builders, everyone thinks that's over and that rising rates are going to doom them. So they're dirt cheap. Auto stocks of any kind, both the manufacturers, some of the parts guys, the retailers, those are all dirt cheap. Agriculture's dirt cheap. A ton of the retailers are dirt cheap, but some of those have these rising earnings. So this is a unique time period. So we've got 35 of them. I had to pick 5 out of the list. And then I'm going to talk a little bit after I give you the 5, what some of the other ones were. So a lot of these names are ones we have been talking about for a couple months now on the podcast because the story hasn't really changed with these and the earnings still look great. And then we'll see what happens when we come into this earnings season with some of these, but the trend should continue with most of these. So I tried to pick them in diverse industries, so there's not more than one in any industry here. And the interesting thing about the 35 is that they were really in many different diverse industries. There wasn't one area that completely dominated the list, not yet. We'll see what happens after earnings season. But so, for instance, there wasn't like 10 banks on this list and then 25 other stocks. No. So that's good. And let's dive right in and see what they are, because I know you want to know. Okay, so the first one is energy. I'm kind of surprised that the energies are making it on there because while the E has been rising, maybe the growth story might not be there, or other things weren't there, or the rank, it was not a number one, or that kind of thing. But the only one that to make it on here was Exxon, ticker XOM. PEG is just 0.8. It has a PE right now of 11.6, and earnings expected to be up this year in 2022 now. I'm already looking ahead. So 2022 expected to be up 21.6% to 616 from 507. This one pays that big dividend yield, still 4.9%. The shares have been hot. They're up 51% in the last year. They're hitting 2-year highs. But remember, for all of these oil stocks, it's been pathetic and even more pathetic over the last at least 5 years, if not longer. So if I were to look at the 5-year, this is well underperforming the S&P 500. I'm not even sure it's in the green over 5 years. I didn't look. But yeah, it's not been good, but that was then and this is now. And the situation has changed. This is going to be a good year for the energy side, even without crude moving any higher here. They are all making great free cash flow with crude anywhere, above $60 essentially for WTI. So something to keep in mind, but the only one who made the list, Exxon, XOM. Okay, then we're going to switch over to the drug stocks. This one is Pfizer, PFE. We've talked about Pfizer over the years on various episodes because it's always been cheap. But really the stock went nowhere pre-pandemic, and people were concerned about, what kind of products they had going into the future, and that there really was no growth there. And the stock just has really underperformed the S&P 500 over the prior years up into the pandemic. Now they're pandemic play, and earnings expected to be up 36% in 2022 to $5.70 versus $4.18 this year. And PEG is just 0.8 as well. PE 9.95, so almost 10, but that's still really cheap. Dividend is yielding 2.8% right now for Pfizer, and 1 year these shares are up 50%. So quite a ride, but they're still cheap. So Pfizer, one of the big cap drug guys that is qualifying on the growth side for the first time in a long time for Pfizer. Okay, then we're going to switch over to agriculture fertilizers. There were 2 fertilizers on the list, but I chose CF Industries, ticker CF. They're a producer of ammonia. They also have urea, UAN for the nitrogen side for the fertilizers. But their big thing right now is to be, and I'm quoting, forefront of clean hydrogen and ammonia supply. So they're big into the ESG and joining the clean energy type of revolution that's going on right here. But it's really the fertilizer pricing that's soaring right now that's driving their earnings. So for this year, 2022, earnings are expected to be up 246% for CF Industries to $12.40 from $3.58. That's a huge jump. It takes a lot to get a company to go from $3.58 to $12.40 in just 1 year. We'll see if they can do it. PEG right now is just 0.9. PE is just 5.6 because the street's not totally sure if that's going to happen, right? So even though the shares are up 60% in the last year, they're still like, it's going to be good, but we're not sure how good. And nobody's really piling into the fertilizer stocks. They're not getting any love. They are true value stocks here, kind of being ignored by the street right here. Also, people are concerned that it's going to be peak earnings and that these prices are going to come down pretty swiftly and it's all going to go away. So not as many people piling in. They do pay a dividend yielding 1.7% right here. So that's CF Industry, CF. I like all the fertilizer stocks right here, and they're all cheap. Okay, then we're switching over to the banks, and this is the only bank that made the list because the banks are about to report earnings. So nobody's really raising their earnings estimates for the most part heading into the numbers, although we've had a few pre-announcements from a couple of banks. So some of them may be getting some changes in their earnings estimates ahead of time, but everybody else, we're just kind of waiting, and then the analysts will be doing their changes, and we will get many more that are Zach's number ones. But also we had to have that peg. So we had to have that growth, and that's a little more unusual to come by for the banks until the Fed raises rates. But this one is Comerica, ticker CMA, one of my favorite regional banks. They're in Texas. So you want to be in a bank that's in a hot regional economic market there. And Texas is red hot. And we're also going to have energy rebounding, and that's one of their biggest industries as well. So Texas is also going to see a lot of gains from the energy recovery. So PEG is just 0.5. The PE's on the bigger, higher side.